Hi. So in continuing from my video from the last lecture, so this is on part 2, International Accounting Standards. So now I'm going to talk about IAS number 16. So IAS number 16 is titled Property Plant Equipment. Now, property plant equipment is the term we use to describe tangible non-current assets. Okay. So according to this standard, all this is covered in the subject matter. Okay, recognition of the assets, how to determine their carrying amounts, the depreciation charges, and the impairment losses. So impairment loss is something I will discuss more in detail later. Okay, so before we start off, you have to know these definitions. So I'll go through them one by one. Property, plant, and equipment. So these are tangible assets, as in non-current assets held in use in the production or supply of goods and services. Okay, so simply to say, these refer to tangible non-current assets which can provide the business with future economic benefit, more than a year, of course. Okay, and then depreciation. So depreciation is the systematic allocation of the cost of the tangible assets, actually. The systematic allocation of the depreciable amount of an asset over its useful life. So depreciable amount means the amount from the cost that we're going to depreciate. So in most cases, we don't depreciate the full cost. Okay, we only depreciate a portion of it. So for example, if an asset costs 100,000 and we were to use it for 5 years and the estimated disposal value is 20,000, so the depreciable amount is 100,000 minus 20,000, which is 80,000. So as you can see here, we're not converting the full 100,000 into depreciation expense, but rather 80,000. That's because the asset is expected to be sold for 20,000. So which means 20,000 is the minimum value, expected minimum value of the tangible non-current asset. Okay. So useful life. So this refers to how long we can, or with how long we plan to use the asset throughout its tenure. So this length of time is determined right at the start when you purchase the asset. This value is predetermined. Okay, residual value is how much we expect to sell the asset in the future. Of course, residual value is just an estimate. When the actual time comes in the future, the amount that we sell or dispose the asset for will most probably be different, a value different from that of residual value. But that doesn't matter because that difference will be adjusted through the profit or loss on sale of non-current asset. Okay. Fair value. So fair value refers to a value agreed between two parties, two knowledgeable parties. Simply put it, a value agreed upon between two parties, two willing parties in an arm's length transaction. Okay. Carrying amount. So carrying amount refers to the amount at which an asset is recognized in the SOFP, which means after deducting accumulated depreciation and impairment loss. So carrying amount is the cost minus accumulated depreciation minus impairment loss. Okay, recognition of the asset in the financial statements. So this section deals with the criteria for us to recognize something as non-current asset. So number one, the asset is probable, it is probable that future economic benefits will flow to the entity. So if it can be proven or established that future economic benefits will flow to the business, then we recognize this item as a non-current asset. And secondly, the cost of the asset secondly, the cost of the asset can be reliably measured. So if these two criteria are present, then we can recognize the item as a non-current asset. Now, in addition to the cost of the non-current asset itself, there are some additional costs which are associated with the asset, which, if it can be established, qualifies for these costs to be added on to the non-current asset. So which means these are what we have studied in the chapter called capital expenditure during the IAS level of accounting. Okay, so the general rule is that all costs incurred in bringing the asset into its current operational state of use should be capitalized. Okay, so here are some examples of, apart from the cost of the asset itself, here are some examples of other associated costs which can be added on to the non-current asset cost and eventually be depreciated. Okay, so the standard also provides guidance on what must be excluded. That means what should not be included in the cost of the non-current asset. So these items, any general overhead costs, any startup costs of a new business, okay, or the cost of introducing a new product. Example, advertising. Now, when it comes to valuing the asset, okay, there are two models that we can apply here. One is called the cost model. So under the cost model, we keep the cost as constant and we keep on depreciating every year and adding on. So under the cost model, we show the cost less any accumulated depreciation to arrive at the carrying value. Okay. On the other hand, the revaluation model is where we will revalue the assets when necessary and decide on any impairment losses. Okay, so revaluations are to be made regularly to make sure the carrying amount does not differ significantly from the fair value of the asset at the date of the statement of financial position. Okay, so the statement provides further guidance on the use of fair values in the revaluation amount. So in the case of land and building, usually this valuation process of land and building is carried out by a team of professional valuers. Okay, but in the case of plant and equipment, we follow what the market value is. So which means we need to do some research as to what the current market value is. So long as the value, the carrying amount and the market value is not so far off, right? If it's far off, then we need to revalue it. Okay, this section talks about depreciation. Well, you've already studied depreciation. So depreciation refers to the loss in value of non-current asset. So, yeah. So in calculating depreciation, one of the components that we need to consider is the useful life of the asset. So when considering the useful life of an asset, these few facts, these few points should be considered. Okay, the expected usage of the asset, its capacity or output, the expected physical wear and tear, right? Is there any technical or commercial obsolescence? Meaning, is the asset going to go out of use? Okay. Legal or other limits imposed on the use of the asset. So after considering all this, then we can decide on the useful life of the asset. Land is not depreciated, freehold land. Okay. Other than in the case of a mine and quarry, because in a mine or quarry, they contain minerals, they contain resources that we want to exploit, extract, sorry. So these are depreciated, but freehold land is not depreciated. So land and building are to be separated out. So land is not depreciated, but buildings are depreciated. So in calculating depreciation, these are the approved methods. But for A levels, usually what is relevant is the straight line and diminishing or reducing balance method. Okay. So the entity, as in the business, must choose a method of depreciation which reflects the pattern of usage. You see, sometimes the same asset can be used differently according to two or more different businesses. So for example, a motor car the same car, say for example, a Volvo. One business might use the Volvo. The Volvo might be used to meet clients, or might be used by the managing director to meet clients, okay, in the case of a small business. Okay, but in the case of a big business, the Volvo may be used as a salesman's car. Can you see? So, if it's used as a salesman's car, then most probably the Volvo will be used more frequently. So the business which uses the asset more frequently will have to depreciate in a manner that the depreciation is higher. Okay, so the entity must choose the depreciation method in accordance with their planned usage of the asset. Okay, derecognition. Derecognition is when we no longer recognize or we no longer want to keep the asset in the books. So this is where when the assets are sold, we need to derecognize them. Therefore, we need to remove the assets from the books, all information pertaining to the asset. So that's why you have been taught before that when we dispose a non-current asset, we have to remove the cost, the accumulated depreciation, record the selling price or the trade-in value, and then calculate the profit or loss on disposal. Okay. So disclosure in the financial statement. So for each class of property, plant, equipment, the financial statements must show these following. Okay. Right. So under IAS 16, a very important element is what we call the schedule of non-current assets. So in exam questions, they will very often ask you to prepare a schedule of non-current assets in accordance with IAS number 16. So what does that mean? You need to record the schedule, construct the schedule of non-current assets in this format. So in this format, we break assets by their categories. Okay, there will be a total. And then what you see here is the movement in cost. And this is the movement in provision for depreciation or rather accumulated depreciation. And down here we have, of course, it's stated here as net book value, but nowadays we call it carrying value. Okay, the carrying value at the end of this year, as well as the opening carrying value. Okay. Okay, moving on to IAS 36. So IAS 36 deals with impairment of assets. So impairment. Now, impairment refers to the reduced capacity of an asset to provide us with future economic benefit. So before we delve in further, we need to understand these few terms. Okay, starting with this impairment loss. So we would have an impairment loss if the carrying amount is greater than the recoverable amount. I will teach you shortly how to calculate the recoverable amount. Okay, carrying amount, if you recall, is the cost minus accumulated depreciation, right? Minus the impairment loss. So the carrying amount, the amount at which the asset is recognized in the SOFP after deducting accumulated depreciation and accumulated impairment loss. Okay, recoverable amount. What is recoverable amount? It is the higher, I repeat, higher between the value in use and fair value less cost to sell. Okay, so fair value is the amount for which an asset could be exchanged. You can take it as the selling price of the asset. Okay, but what we need to capture here is the fair value less any cost to sell. Okay, okay. Now value in use is the present value of the estimated future cash flow. Now, to calculate present value, this is taught in the last chapter in A2. So since I have not taught you that yet, so for now, present value will be given by the question. So all we need to do is we compare the given present value and the fair value less cost to sell and select the higher between these two amounts. So the higher between these two amounts that we selected is called the recoverable amount. Okay. So at each time, when the carrying amount exceeds the recoverable amount, then we need to impair the asset. Okay. Okay. Calculations will follow shortly. Okay. Identifying an asset that may be impaired. So at the end of each reporting period, an entity is required to assess whether there is any indication that an asset may be impaired. Now, in real life, they will screen through the assets physically and single out. They will select assets which they feel cannot provide the business with the expected future economic benefit. So we will select this and we will carry out an impairment for these assets. Okay. Okay, indications of impairment, external sources, market value decline. So that means the market value of the assets decline. Okay? It's like nobody wants it, right? Negative changes in technology, markets or economy or loss. So any changes in technology would deem this asset to be irrelevant. So if it's irrelevant, then it cannot be used as planned to generate future income. Okay. Increase in interest rates. Okay. The net assets of the company higher than the market capitalization. So these are the indications of impairment. Okay, for internal sources, if the asset is of obsolescence or damaged physically, or the assets are idle, right? Or worse, or the assets do not perform as expected, then it's time to impair them. Okay. So recognition of an impairment loss. So an impairment loss is recognized whenever the recoverable amount is below the carrying amount. So this is important. Whenever the recoverable amount is lesser than the carrying amount. If the carrying amount, so in other words, when the carrying amount is greater than the recoverable amount, then the difference will be an impairment loss. If the carrying amount is equal or less than the recoverable amount, then we do not need to impair the assets. Okay. So the impairment loss is recognized as an expense, important in the statement of profit and loss, unless it relates to a revalued asset. So for revalued asset, the impairment loss is treated as a revaluation decrease. Okay. So depreciation for future periods must be adjusted. So after impairing the assets, the planned usage will change. So therefore, we need to change the depreciation accordingly. Okay. So this part deals with disclosures. Impairment losses either recognized or reversed should be disclosed by asset category, by asset class. Okay. Now, here's the calculation bit. Okay. So I will take you through this exercise. So there are 3 assets here. So take each asset as a separate question. Okay. Asset 1, the carrying amount. Asset 1, the carrying amount is 30,000. Okay. Fair value less cost to sell is 10,000. Value in use is 50,000. So we need to compare value in use and fair value less cost to sell. So we pick the higher, always pick the higher between these two. So the higher between 10,000 and 50,000 is 50,000. So this higher value that we just selected is called the recoverable amount. So in the case of asset 1, the recoverable amount is 50,000. Okay. Then we would compare the carrying amount and the recoverable amount. So since the carrying amount is 30,000, which is lower than the recoverable amount, so no need to impair. Okay, let's look at asset number 2. The recoverable amount is the higher between 14,000 and 12,000. So therefore it's 14,000. Okay. The carrying amount is 15,000. So if you can see, the carrying amount has exceeded the recoverable amount by 1,000. So which means we need to bring down the value of this asset from 15 to 14,000, which means we need to impair. So the amount is 1,000. So the double entry would be to debit impairment loss for 1,000 and credit the non-current asset, whichever category it is. For 1,000. Okay, so this is for asset number 2. All right. So therefore, asset number 2 will be shown in the SOFP as 14,000 after taking off the 1,000. So there you go. Okay. Okay. As for asset number 3, the recoverable amount would be the higher of 15,000 and 9,000, which is 15,000. The carrying amount is 20,000. So therefore, we need to impair this asset. So the impairment amount would be for 5,000, 20,000 minus 5 to arrive at 15,000. So the same way, we will pass this double entry for 5,000 for asset number 3. We would have to debit impairment loss 5,000 and credit non-current asset 5,000. Okay. Okay, next we come to IAS 37. So IAS 37 deals with provision, contingent liability, and contingent assets. Okay, so we first need to understand these few terms. Provision. So what is provision? Provision is a liability of uncertain timing or amount. That means we know that we owe, but the amount is an estimate. Okay, the amount is uncertain, and when we have to pay is also uncertain. Okay, liability is a present obligation as a result of past event. Because of past event, we are obliged to pay, whereby the settlement of this liability is expected to result in an outflow of cash, outflow of resources. Okay, okay. Contingent liability is a possible obligation depending on whether some uncertain future event occurs, or a present obligation but payment is not probable or the amount cannot be reliably measured. So that's contingent liability. Okay, so that means contingent liability means it is a form of liability. I mean, it might be a liability, a possible obligation, but the amount or the likelihood of it cannot be ascertained accurately. Okay, so the opposite of contingent liability is contingent asset. So a possible asset that arises from past events whose existence will be confirmed only by occurrence of one or more uncertain future events, not wholly within the year. Okay, now, how do we recognize a provision? So recognition of a provision or a contingent liability depends on the probability of liability resulting. Here's the key. Depends on the probability of the liability resulting. So a provision must be recognized if a present obligation exists as a result of a past event. This is the one condition. The other condition is that payment is probable and the amount can be reliably estimated. Okay. So when they use the word probable, that means most likely we have to pay. And of course, the amount can be established, reliably established. An obligating event is an event that creates a legal or constructive obligation. So here they're defining what an obligation is. So that means if you fail to meet this obligation, we could be sued. This obligation is legally binding. It means we have to pay. We cannot escape from it. Okay. So a possible obligation, a contingent liability, is disclosed but not accrued. So meaning if the obligation is possible, okay, then the amount is disclosed in the notes to the accounts, but we do not record a transaction for it. It doesn't appear in the SOIP. That's what it means by not accrued. where the possibility of payment is remote, no accrual or disclosure is required. That means when the obligation, when the possibility of payment is very, very low, okay, we do not record as a transaction, and we also do not disclose it in the notes. Okay. So the amount recognized as a provision should be the best estimate at the date of the SOFP of the expenditure required to settle the present obligation. Okay, contingent asset. These should not be recognized in the financial statement, but should be disclosed where an inflow of economic benefits is probable. Okay, so can you see the word probable, when you compare the word probable to possible, probable is a higher probability. Okay, so when if the future economic benefit is probable and the amount is material, that means large enough to make a difference, then it should be disclosed. Okay, where the inflow of economic benefits is possible or remote, then there should be no recognition and no disclosure. So possible or remote, for contingent assets, we do not disclose, we do not recognize. Okay, the meaning of do not recognize means we do not show it as a transaction, so it won't appear in the SOFP. Okay, here are some examples. Example of recognition of provision or contingent liability. So a company manufactures shampoo. So a customer has sued the company claiming that the shampoo has caused burns to her head. So the customer is claiming damages of 100,000. Okay, which means the business is being sued. So lawyers have advised the company that it is possible that the customer may win the case. Okay, so as the outcome of the case is uncertain, as in a possible successful claim, the company is not certain to be liable. Remember, possible means the chances are low. Okay, so this is a contingent liability. So in this case, the company should not record it as a transaction, meaning should not make a provision, but should disclose details of the case in its notes to the accounts, as what was mentioned here. A possible obligation is disclosed but not accrued. Okay. Okay, IAS 38, intangible assets. So IAS 38 deals with the intangible assets. So intangible assets are those as kind of assets which do not have a physical existence. So here are the three main attributes of an intangible asset. For something to be called an intangible asset, the assets must be identifiable. The assets must be controlled by the entity, because only then will the entity be able to use the intangible assets to provide, to obtain future economic benefit. Okay, so the entity must be able to obtain future economic benefit from the asset. So here are some examples of intangible assets: patent, trademarks, customer lists. So all these do not have a physical existence. You can't see or feel or touch it, but rather it can be felt. Okay, right. So what are the conditions for us to recognize something as an intangible asset? Here are the two conditions. It is probable that the future economic benefit attributable to the asset will flow to the entity. Okay, and the amount, the cost of the asset can be reliably measured. Okay, so if an intangible asset does not meet both of the above mentioned criteria, then IAS 38 says that we should not treat it as a non-current asset, but rather as an expense if both of these criteria are not met. Okay. Okay, specific cases. So the standard details initial recognition criteria and accounting treatment for special cases as follows. Okay, research and development costs. Okay, research costs. Research cost is expensed, right? Because at the research level, we are not sure that anything is going to be taken further to the next level. Okay, but for development costs may be capitalized, meaning it may be treated as an intangible asset only after the technical and commercial feasibility of the asset have been established. So we can establish that this development cost has some technical and commercial feasibility, then it can be recognized as an intangible asset. So in other words, the entity must prove that this development cost can cause future economic benefits to flow into the business. Okay, internally generated brands. Okay, these should not be recognized as asset because these brands are unique only to the company. Okay, so this should not be recognized as assets. Okay, computer software. If it's an internally generated computer software, then it should be charged as an expense because internally generated computer software is only unique to the business, right? If you want to sell it, right? Nobody else would want to buy because it doesn't benefit them. Okay, unless of course we can prove that there is some technical and commercial feasibility, then we can classify it as an intangible asset. So here's a list of other types of costs which must be charged to expense. Yeah, all these are not to be classified as intangible assets. They should be charged, recorded as an expense. Okay, so the intangible asset also has got two models, the cost model and the revaluation model, similar to what I discussed just now in IAS 16. Okay, and similar to IAS 16, we also need to look into the life of the intangible asset. So for each type of intangible, for each class of intangible asset, the following should be disclosed. Okay. Okay, the useful life or amortization rate. We use the word amortization for intangible asset. It's technically the same as depreciation, but we use the word amortization. Okay, the amortization method as in the depreciation method. Okay, and the carrying amount, which means the cost less the accumulated amortization. Okay, we need to disclose the accumulated amortization and impairment loss. So all this is similar to IAS 16. Right? Okay, so that's it. So now let's look at some past year questions. So I've selected one. Okay, I'm looking at May 23, paper 32. So this is the insert file. May 23, paper 32, question number 2. Okay, so this is from May 2023, paper 32, question number 2. So as mentioned earlier, IAS usually it appears as part of a question and not as a full question. Thank God for that. Okay. So M Limited's statement of financial position at 31st December 2022 has been compared with previous year. So the results are as follows. So in comparing this year with last year, so what we're given here is the increase or decrease in the value of these items. Okay, we have land and building carrying value, machinery carrying value, we have inventory, trade receivables, cash and cash equivalents, trade payables, ordinary share capital, share premium, decrease, retained earnings, increase, 8% bank loan increase. Okay, so we also told the following information. The carrying value of land and building at 31st December 2021 consists of land at the cost of 150,000 and building at the cost of 400,000. So no depreciation had been provided on either the land or the building. So the building was purchased on 1st January 2021. A new building was acquired in 2022. So on 31st December 2022, it was decided that depreciation should have been provided for both buildings at an annual rate of 5% using the straight line method. So the depreciation charge for 2022 was 26,200. Okay, the prior period adjustment had been made accordingly. Okay, so a machine with carrying value of 28,600 sold for 29,500. The depreciation charge of machinery for 2022 was 42,600. And then on 1st June 2022, an issue of 60,000 bonus shares made on the basis of one ordinary share for every 10 held. So the policy of M Limited is to keep its reserves in the most flexible form. So the bonus issue was fully covered by the share premium. So on 1st August, additional new shares were issued for cash at 150 per share. So on 1st March 2022, the 2021 final dividend of 8 cents per share was paid. On 1st October, an interim dividend of 12 cents per share was paid on the shares held on that date. And then the 8% bank loan of 100,000 was taken out in 2020. A partial repayment of 60,000 was made on 1st April 2022. And lastly, cash and cash equivalents at 31st December amounted to 42,000. Okay, question. Explain why M Limited made a prior period adjustment in information 2. Support your answer by stating the relevant international accounting standard and the accounting treatment. So in information 2, here, so yeah, so the depreciation was 20,000. So how do you get 20,000? It's 400 times 5% on the existing building should have been made for 2021. Okay, now it happens that there's a change in accounting policy, right? So according to IAS number 8, accounting policies changes in accounting estimates and errors, we need to adjust the figure. So the prior period error is adjusted against the retained earnings brought forward. So which means the adjustment for last year is done this year. Okay. And because this affects the retained earnings carry forward of last year, that's why it's adjusted from the retained earnings brought forward of this year. Okay. So calculate the profit for the year. So we use the increase in retained earnings. We start off with that, and then we include the prior period adjustment. Okay, and then we put in the dividends paid, and we get the profit for the year. All right. So next question is prepare a statement of cash flow in accordance with IAS 7. So IAS 7 says that a statement of cash flow should be prepared in the format which was taught to you. That means we show the cash inflow and outflow arising out of 3 activities, namely the operating, investing, and financing activity. Hence, yeah, we present it in this format. So I won't go into specifics because this video is to focus more on IAS. Okay, so that's all for this question. Let's look at another question. Okay, the next question comes from May 2021, paper 32, question 2, right? So this question, part A is on accounting ratio. So IAS only kicks in part C, okay? Right, so I'll just deal with part C, yeah? So in part C, we have to prepare the non-current asset schedule. So if you recall, the non-current asset schedule is a format in accordance to IAS number 16, okay? So this is the format as I showed you earlier. We break down into the asset category. Okay, we show the movement in cost. We show the movement in accumulated depreciation. And we calculate this we call net book value then, but we call it carrying value now. So the carrying value at the end of this year and the carrying value at the start of the year. So the calculation of these figures refers more to your basics. So I'm sure you can do this on your own. But my point is the format should be made in this way in accordance with IAS number 16. So this is an example how you can be asked IAS in a question. It comes as part of a question. Okay, so that's it for this video. So please try the remaining questions. That's all. Thank you.